In today's video, I will teach you how to pay less taxes. So this video is not for billionaires, it's not meant for multimillionaires, no. I made this video for the 99% of Americans. It's very simple what I'm trying to achieve. I want you to keep more of your hard-earned money. Less money for the IRS, more for you. That is the purpose of this video. So here are the actions that you can take by December 31st. The first one that I want to start off with is the 0% tax rates on long-term investments. So this is not a myth, this exists, and I want to clarify this for you. If you buy and hold a stock or crypto for longer than 1 year, and then you sell it for a gain, it will be 100% tax-free if you are single and you make about $60,000 a year or less, head of household, and you make about $80,000 a year or less, married filing jointly, and make about $120,000 a year combined or less. I want you to keep in mind that those are the income thresholds at the time of making this video that includes the standard deduction. And I just want you to know that every year this gets adjusted for inflation. So if you're watching this in a subsequent year, then those numbers, those figures are probably a little bit higher. Okay, so this is called the 0% long-term capital gains. A lot of people don't know about this. Even though this is a huge tax break where you pay 0%, we're talking tax-free. If you're normally in this income range, then please take advantage of long-term investments. This is a no-brainer. So listen, I personally have a lot of friends and family members that make more money than this, but if they have a year where their commissions are not as good as they normally are, or if they work less or for whatever reason, I always tell them to take advantage of the situation. This is a good opportunity to lock in long-term capital gains by December 31st and have it tax-free. Please note, and this is very important, that your long-term capital gains will be tax-free for your federal income taxes with the IRS. This does not apply to your state income taxes, but it's still a great deal because state income tax is less than federal income taxes. And best case scenario is that some states do not have an income tax. So please look into this. Keep this in mind for future years as well. And remember, do this by December 31st. Number 2 is tax loss harvesting. If you have money in the stock market, then you need to know about this. If you bought a stock and the stock goes up or down regardless, it doesn't matter. Nothing happens for tax purposes until you sell the stock. So in other words, a tax consequence is only triggered when you sell the stock. This means that you can manipulate the situation for tax purposes. You can control the timing of when you claim the gain or loss for tax purposes. So that is a lot of power in your hands, and with great power comes great responsibility. So I want you to be responsible and get this right so that you can optimize your tax outcome. If you bought a stock and you're up on the position, then you should consider selling that stock after December 31st so that you will not have to worry about the tax consequences for another 12 months. So basically push it off until next year. This procrastination works in your favor unless you have reason to believe that your stock is going to crash and burn by December 31st. In that case, well, don't hold on to your stock until next year. Sell your stock right now, take the money and run. Take your profits and run. Now, if you bought a stock and you're down on the position, you could sell the stock by December 31st to claim the loss as a tax write-off. So for tax purposes, your losses in the stock market are valuable because they reduce your taxable income and you pay less taxes. So this is a common tax strategy that investors take advantage of typically in December. This is called tax loss harvesting. But please note this because I have to give you this warning. If you sell your losers now to get the tax write-off, do not repurchase the same stock within 30 days. If you do, then you cannot claim the loss as a tax write-off. It's called the wash sale rule. Now let me give you an example to clarify. Let's say that you sold the stock on December 28th of 2023 and you lost $1,000. You can claim a $1,000 tax deduction on your tax return and you will pay less taxes. But if you repurchase the same stock on January 3rd of 2024, just a few days later, then you cannot claim the tax deduction for tax year 2023 because you repurchased the same stock within 30 days. So please watch out for that trap. for that rule. But please take advantage of tax loss harvesting by December 31st. Number 3, Roth conversions. I personally believe that Roth retirement accounts are one of the best tax advantage accounts, arguably the best because they have significant advantages. All the money that you make in a Roth retirement account will not be taxable. So how awesome is that? You will never pay taxes on money that you make in a Roth retirement account ever again. So that's a pretty sweet deal. But here's the thing. If you want to put money into a Roth retirement account, like a Roth IRA or a Roth 401k, then you can do that tax-free. So in other words, you do not pay taxes to put money directly into your accounts. However, when you're trying to move money from a regular retirement account into a Roth retirement account, that's a different story. For example, if you're trying to get money from your 401k to your Roth IRA, that is a taxable transaction. But some people love Roth retirement accounts so much that they're willing to pay the price. They're willing to transfer money from a regular retirement account to a Roth retirement account and pay the tax. That's because they pay the tax now, but they'll never pay taxes on all the money that they make in their Roth retirement accounts ever again. But that price to pay is a big burden when your tax rate is 24% or 32%. But if you are in a lower tax bracket this year, now is the time to do the transaction. Take advantage of the situation. This is your opportunity to seize the moment, and you have until December 31st to do so. What I'm ultimately saying is that if you're in the 12% tax bracket or the 10% tax brackets, and especially if you can do this tax-free in the 0% tax brackets, you should consider converting your money from your pre-tax retirement accounts to an after-tax account. And this is called a Roth conversion. Number 4, 529 plan. You can put money into your 529 plan by December 31st to reap the benefits on your upcoming tax return. So you can think of a 529 plan like a retirement plan that is designed for future education expenses. And it's good to do it in a 529 plan because you get big tax advantages. Most people set up a 529 plan for their children, but it doesn't have to be for your child. It could be for your grandchild, your niece, your brother. It could be for yourself. So true story, I have to tell you this one. I had this client and he was doing his MBA at the University of Chicago, and he put money into his 529 plan and then immediately took that money and paid his tuition. And by doing that, he would save $500 in state income taxes. So I had to hand it to him as he's a smart guy, working the system like that. So if you didn't know, here are the benefits of a 529 plan. You put money into a 529 plan. You decide how to invest that money in the plan, and it grows tax-free. And if you use the money for qualified education expenses like college tuition, then all the gains within the accounts are tax-free. Now I want to clarify the details. Each state has its own 529 plan. If you create a 529 plan in Illinois for your child, it does not mean that your child must go to a college or university in Illinois. Your child can go to any state and use that 529 money tax-free. If your child does not go to college, then you can switch the beneficiary of the plan to another child, to your nephew, to your grandchild, etc. Another important thing that I must clarify is this, and this is pretty bad. Okay, so when you put money into a 529 plan, you do not get a tax deduction with the IRS for federal income taxes, but most states will give you a tax deduction on your state's income taxes. However, some states do not have an income tax, such as Texas or Florida, but if that's your case, you still benefit from the tax-free growth and the compounding. And then there are some states, such as California, that do not give a tax deduction for 529 contributions. So that's sad, that's at the time of making this video, but hopefully they change that. Anyways, don't forget about the 529 plan and funding it by December 31st. Number 5 is HSA contributions. So please do not forget about your HSA contribution, especially if you are self-employed. So for this one, you have until April 15th to make your contribution and get the tax deduction. An HSA is a health savings account. It's a tax advantage account to pay for qualified medical expenses. An HSA is awesome because you get to use pre-tax money to pay for your medical expenses. Additionally, the money in your HSA account grows tax-free, your HSA does not expire, and the money within the account does not have a use it or lose it feature. But you know what? I'm not your doctor, so I'll leave it at that. And let's move on to number 6, which is timing your expenses. If you're a gig worker, independent contractor, sole proprietor, or business owner, then listen up. Especially if you're an Uber driver or DoorDasher, I'm talking to you. If you're running a side gig, then here's your chance to shine. Get your expenses in by December 31st. But listen, I am not telling you to spend money unnecessarily. Please don't do that. Please do not waste money. But if you're going to pay for an expense in January, you might as well do it by December 31st so that you can claim the tax write-off for this year. So you're going to come out ahead because the time value of money. So here's how it works. If you buy something online or at the store with credit card, the IRS will go by the transaction dates, not by the post dates. So if you make the purchase by December 31st, then you can get the tax write-off this year on your upcoming tax return. So it doesn't matter if you buy something on December 31st and the transaction posts on, let's just say, January 3rd. It still counts as December 31st, so it doesn't matter if you pay your credit card bill in January. It goes by the transaction dates. It's the same concept. If you're paying for a business-related expense by check, so less people use checks nowadays, but you'd be surprised. Anyways, it's the same rules. It goes by when the check is out of your hands. So if you're writing a check, it goes by when you drop it off in the mailbox or when it's out of your hands. So it doesn't matter when they cash your check. So if you have to buy electronics, buy supplies, pay a contractor, prepay expenses, could be rent, utilities, whatnot, get it done by December 31st and get the tax write-off now. It's better that you claim the tax deduction this year instead of waiting around for your tax deduction 12 months later. Take the benefit now, not later. So this is all under the assumption that you will be in the same or similar tax bracket from one year to the next. Number 7 is your FSA. Don't forget about your flexible spending accounts. So this is the worst way to waste money. A flexible spending account is a type of plan where you can pay for certain expenses with pre-tax money. So this includes childcare, dependent care, and medical expenses most commonly. So the bad thing is that FSA plans are use it or lose it. So if you put money into the account, but you don't spend it, you lose it, which is a nice way to burn money. However, check with your employer to see if they have a grace period. If not, get your last-minute expenses in. Number 8 is your traditional IRA. So this is a friendly reminder that you have until April 15th to get your traditional IRA contribution in. So this one is not December 31st. A traditional IRA is a retirement plan that you have outside of your work. So just so you know, you can put money into a 401k and a traditional IRA. You get a tax deduction for putting money into a traditional IRA, but under certain income and plan limitations, you may not qualify for a tax deduction. Please note that these are some of the many options that are available to you to lower your taxes. For most of these, you need to take action by December 31st. If you miss that crucial deadline, then you'll get the tax benefits next year rather than this year, which is fine, but it's better if you get the tax benefits now rather than later. I want to end by telling you this. This channel is a great resource for your personal financial education, and I want to see you become very successful. So please subscribe. I thank you for the support, and I wish you a very nice day. Take care. Visit TaxUSA.co for tax filing and bookkeeping services.